Welcome to Market Brief After Hours. We have a packed show today. Risk appetite definitely took a breather on Tuesday. We saw investors stepping back from recent record highs, and there is a lot to unpack, from rising oil prices and a massive geopolitical shakeup in the energy sector to some fresh uncertainties surrounding the big artificial intelligence leaders.
It was definitely a day of recalibration. The markets have had a phenomenal run lately, but today, reality started to bite back a bit. We had geopolitical tension, shifting supply narratives, and some profit-taking right before the heavy hitters in tech report their earnings.
Let's get right into the key takeaways for the major U.S. benchmarks. The S&P 500 and the Nasdaq Composite both pulled back after their strong recent gains. The S&P 500 fell 0.49% to close at 7,139. Meanwhile, the Nasdaq took a heavier hit, sliding 0.90% to finish at 24,664.
That Nasdaq drop really highlights the pressure on semiconductor shares and the broader AI-linked sectors today. We saw the VanEck Semiconductor ETF lose about 3%. NVIDIA was down over 1%. Broadcom dropped more than 4%, and Oracle declined around 4%. It's a clear sign of profit-taking. Investors are getting a little nervous about elevated valuations and whether the momentum in AI can actually sustain these prices.
Interestingly, the Dow Jones Industrial Average held relatively firm. It slipped just 0.05%, dropping 26 points to close at 49,142. What kept the Dow afloat while the others sank?
Defensive buying. Investors rotated out of the volatile tech names and into steadier blue-chip stocks. A massive support pillar for the Dow today was Coca-Cola. They posted stronger than expected earnings, which sparked a nearly 4% rally in their stock. That really cushioned the broader market weakness and showed that when inflation and energy concerns flare up, capital tends to hide in reliable consumer staples.
Speaking of energy concerns, the dominant macroeconomic story today has to be the United Arab Emirates. They confirmed they are leaving OPEC effective May 1st. That is a massive shift.
It reshapes the entire supply narrative. The UAE was OPEC's third largest producer in February, sitting right behind Saudi Arabia and Iraq. They've done a strategic review and reiterated their goal to lift production capacity to 5 million barrels per day by 2027. Basically, they want more flexibility outside of the cartel's quota arrangements.
And this is happening at a time when crude prices are already sitting near multi-month highs.
Exactly. Add in the stalled U.S.-Iran negotiations and the ongoing risks surrounding the Strait of Hormuz, and you have a recipe for surging prices. West Texas Intermediate jumped over 3% to settle at $99.93 per barrel, and Brent crude rose 2.8% to $111.26. It's a tense market backdrop right now.
Let's pivot over to the European markets. It sounded like a mixed bag over there as investors tried to balance solid corporate earnings against these rising oil prices and geopolitical uncertainties.
Very mixed. The Pan-European Stock 600 slipped 0.3%, with sentiment really fading as the afternoon wore on. But if you look at individual countries, the stories diverge. The UK's FTSE 100 actually added 0.11% to reach 10,333. That was largely supported by energy majors benefiting from those surging crude prices we just talked about. BP, for instance, rose 1.7% after their profits more than doubled expectations.
What about the rest of the continent?
Italy was the standout performer. The FTSE MIB outperformed with a 0.77% rise to 48,040. On the flip side, Germany's DAX fell 0.27% to 24,018. France's CAC 40 declined 0.25% to 8,122, and Switzerland's SMI eased 0.13% to 13,147.
Were there any specific economic data points driving those mainland European moves?
Yes, some concerning macro data came through. Spain's unemployment rate rose to 10.83% in the first quarter. Over in France, joblessness increased by 35,600 in March. And in Italy, despite the stock market gains, producer prices surged 4.2% year-on-year, heavily driven by accelerating energy costs.
Before we head to a break, we should also touch on the Asia-Pacific markets. It seems the technology weakness we saw in the U.S. had a ripple effect there as well.
It certainly did. Asia-Pacific markets largely closed lower. Hong Kong's Hang Seng dropped 0.95% to 25,679, dragged down by heavyweight tech names. China's Shanghai Composite slipped 0.19% to 4,078. That was partly driven by regulatory news, as Beijing ordered Meta to unwind its $2 billion acquisition of Manus.
And Japan had a central bank decision today as well.
Right. Japan's Nikkei fell 1.02% to 59,917. The Bank of Japan kept rates unchanged in a split 6-3 vote. Following that, we saw significant tech drops there too. SoftBank tumbled 9.9%, Advantest lost 5.6%, and Tokyo Electron fell 4.1%. South Korea was the rare bright spot, with the KOSPI rising 0.39% to another record close, driven by names like Hyundai Motor and Samsung SDI. Elsewhere, Australia's ASX 200 fell 0.64%, New Zealand lost 0.86%, and India's Sensex and Nifty declined 0.43% and 0.28% respectively.
It is fascinating how energy costs, central bank decisions, and tech valuations are rippling across the globe. We still need to dive into the foreign exchange markets, check out some critical moving averages, and look at today's biggest individual market movers. But first, we are going to take a quick break. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the equity and energy markets. Now, let's get into the bond and currency markets. Treasury yields were on the move today, which usually signals shifting investor sentiment.
Yes, U.S. Treasury yields edged higher. Investors are closely monitoring these geopolitical developments and sticky energy prices. The 10-year yield rose 1 basis point to 4.346%, while the 2-year yield climbed more than 3 basis points to 3.836%. It reflects a lot of caution ahead of tech earnings and the ongoing uncertainty around the Federal Reserve's path for interest rates.
Did we get any labor data to factor into that Fed outlook?
We did. ADP data showed private employers added an average of 39,250 jobs per week in the 4 weeks ending April 11th. That is slightly below the revised 40,250 pace from previously. The figures point to a broadly stable labor market rather than a sharp slowdown, meaning hiring momentum remains moderate.
Let's transition into Forex. There was some serious technical action today. Let's start with the euro against the dollar.
Euro USD closed at 1.1709, down 0.10%. It spent the session bouncing between 1.1727 and 1.1677, keeping it pinned right near a vital technical pivot. The price ended just above the 100-day simple moving average, which is at 1.1707, and the 200-day moving average at 1.1676. The 50-day sits a bit lower at 1.1651.
It sounds like it's struggling to find a clear direction.
It really is. We're seeing repeated hesitation around that 1.1700 handle. It signals a lot of indecision after the pair was rejected from the 1.2000 zone earlier. Right now, immediate resistance is at 1.1727, and initial support is resting at 1.1677, with that 200-day average providing stronger downside protection.
How is the British pound holding up?
GBP USD finished at 1.3515, down 0.13%. Despite the mild pullback, it is holding above a really clustered support zone. It continues to trade above all the major trend markers, the 50-day moving average at 1.3408, the 100-day at 1.3463, and the 200-day at 1.3415. So even though momentum has cooled off, there is a very firm support band beneath current levels. Resistance remains up at 1.3541.
Moving over to the Swiss franc, it looks like the dollar had a strong showing there.
A very sharp rebound. USD CHF closed at 0.7895, which is up 0.52%. That move pushed the price back above the 50-day moving average at 0.7847 and the 100-day at 0.7857. This definitely improves the near-term momentum. The next major technical barrier is the 200-day moving average at 0.7931. That's the line defining the broader trend resistance right now.
Let's talk precious metals. It wasn't a great day for gold and silver. Gold extended its slide, didn't it?
It did. Gold settled at $4,594, down 1.85%. The metal is under significant pressure because it broke below two key supports, the 100-day moving average at $4,737 and the 50-day moving average at $4,855. That signals a real deterioration in medium-term momentum. However, it is still above the 200-day moving average at $4,239, so the longer-term uptrend is preserved for now.
And silver dropped even heavier.
Silver closed at $73.06, down a steep 3.23%. It remains below both the 50-day moving average at $78.48 and the 100-day at $78.78. But similar to gold, it's still trading well above its 200-day moving average, which is way down at $61.64. There was a long lower wick on the daily candle today, suggesting some buyers did step in near the session lows of $72.04.
Let's wrap up with today's individual market movers. We already mentioned Coca-Cola rallying nearly 4% to help the Dow, but there were some massive swings elsewhere. Centene had a fantastic day.
Centene shares absolutely surged, jumping 14%. The health insurer raised its full-year adjusted earnings forecast to over $3.40 per share. That blew past analyst expectations, and the market rewarded them handsomely.
On the flip side, streaming giant Spotify took a major hit.
Spotify tumbled 13%. They provided their second quarter operating income guidance, and it came in well below market projections. It's a tough environment for growth stocks when future profitability looks slightly clouded.
We also saw some heavy losses in the semiconductor space with Rambus. What happened there?
Rambus plunged 20%. The semiconductor firm reported an adjusted operating margin of 42%, which is down from 46% in the previous year. When you have an AI and tech sector priced for perfection, any compression in margins is going to trigger an aggressive sell-off.
Finally, Alexandria real estate equities led the losers on the S&P 500.
Down 11% for the day. The Real Estate Investment Trust reported first quarter revenue of $671 million, which missed the consensus estimate of $692.7 million. In a high interest rate environment, real estate is highly sensitive to any earnings misses.
It really underscores the fragility of this current market rally. You have geopolitical headwinds, rising input costs, and now we are heading into the bulk of the Magnificent Seven earnings reports over the next few days. Investors are clearly balancing their optimism about corporate profits against the risks of regional conflicts and persistent inflation, especially in the energy sector.
Exactly. The next phase of market direction is going to depend entirely on the corporate guidance we get this week, and whether the technology leadership can reassert itself after today's stumble.
It is going to be a critical week for the markets, and we will be here to break it all down for you. If you find this useful, please follow Market Brief After Hours.